This is a special edition of MacroVoices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of MacroVoices, here's hedge fund manager Eric Townsend.
MacroVoices All-Stars, episode number 1, was recorded on April 29th, 2019. I'm Eric Townsend. MacroVoices All-Stars is the first of several forthcoming MacroVoices Premium offerings, and I'm really excited about it. I'll have more to say about MacroVoices Premium in the Postgame segment of the regular MacroVoices podcast on Thursday evening, May 2nd, 2019. In today's inaugural episode of MacroVoices All-Stars, I'll be interviewing Dr. Pippa Malmgren, petroleum geologist Art Berman, Professor Steve Keen, Julian Brigden, Luke Gromen, and Danielle DiMartino Booth. The All-Stars format was conceived to give you regular, frequent updates from your favorite MacroVoices personalities. The concept is that short-form interviews of just 10 minutes duration allow us to give you access to the latest views from 5 or 6 different All-Stars in a single podcast episode. And because the short-form format is less imposing on our All-Star guests' busy schedules, it also means that you can expect to hear from all of your favorite All-Stars much more frequently, at least once a month, and in many cases, even more frequently than that. Now, don't worry, we'll still be scheduling your favorite All-Stars for long-form interviews on the regular Thursday night MacroVoices podcast. The purpose of the new All-Stars podcast format is to supplement those long-form appearances and keep you updated on our All-Stars views between their long-form interviews on the main podcast. So without further ado, let's dive right into the new format with one of my own personal favorite All-Star personalities, Dr. Pippa Malmgren. Pippa, it came as no surprise to me whatsoever when your book, Leadership Lab, won the title of Best Business Book of 2018. Having read some of your previous writings in the previous book, Signals, came as no surprise to me. But reading between the lines, I think there's a deeper story here that I want to get to because, look, a lot of people write books to try to gain attention because they're making a name for themselves. You've already made a name for yourself. You've advised multiple U.S. presidents. You know, you're not needing to make a name. If I'm reading between the lines correctly, it feels to me like there's a Pippa Malmgren needs to get the world's attention about important subjects personal agenda that I think might be driving you. Am I right about that? And what is it? What's going on here? Because I noticed, you've got a robotics company. You've got lots of things that are profitable and keep you busy, but you seem to spend time wanting to share a lot of your insights with the world. What's going on here?
I'm so lucky. I get to have conversations with so many of the people who are making the world economy go around, whether they're politicians and policymakers or the people running the biggest companies in the world, people who are innovating in technology. And what I find is the framework for the conversation is often off. It's like too narrow. It's not updated. Like, for example, someone will say, well, all the jobs are moving to China. And you're like, that was true 10 years ago, but that's not true today. And so if you want to have a conversation about what's really going on, you have to give everybody a kind of framework for that conversation. And that's really what I'm doing with my books. And also it's very much about inviting the general public because, I'm very lucky in a sense. I'm in a sort of high priesthood of the economists who get to, advise governments and be in the inner circle. But it's the public who gets affected by the decisions. So I'm all about, let's put this in plain English and invite everybody into the room to understand what is the nature of the decision that's being made and how is it going to impact on the general public. I think that's really what drives me. When I finished this last book, which was really about why our leadership is failing, why we have all these problems amongst leaders, whether they're the business leaders lying about the auto emissions or the leadership problem we have in Europe with Brexit and the future of the EU. You can name a million different things, but leadership's kind of fallen down everywhere. And if you don't understand the reasons why, it's really hard to come up with solutions. But my next book, which I've already started, is kind of about holding everybody's hands to explain to them we're at a period of history where we're having a genuine change in perspective. And everybody goes, wait, what? What do you mean by that? So one of the things that caused the Renaissance to actually unfold was that we used to paint in two dimensions. We had 2D pictures. Think of ancient Egyptian paintings. They're very flat, and all the way through the Middle Ages, very flat images of saints and things. But then an architect called Brunelleschi came up with an idea of 3 dimensions and creating literally lines, perspective lines that would allow you to paint in 3 dimensions and build. So the cathedral at the Duomo in Florence, the most famous, building practically of the Renaissance in Italy, is only possible because of the development of a kind of framework, grid lines for thinking in 3 dimensions and then building in 3 dimensions. And this underpins the linear thought process that gave us the scientific revolution and then the industrial revolution. And the perspective change that we're going through today is equally profound. And I'm arguing what we're doing is moving from really still 2D thinking, because most people still think in terms of, I make drones. The first question they ask is, I'm right here. Is it going to bring me a pizza? Right? And so they're thinking it's over there and I'm here, and just bring it across that one plane of dimensionality. 3 dimensions is still kind of new to humans, because up until recently, only NASA really had the ability to show us the 3rd dimension aerial view. Or maybe if you were a pilot of a plane, you got it. But you didn't get to see very much because you're so high. But today, drones are democratizing the 3rd dimension aerial view. And I'm arguing that is totally transforming how we run businesses, how we digitize assets. And we're moving reality, everything that's in front of you, where you're sitting right now, you yourself, the chair you're sitting on, the building that you're in, a digital twin of that is being developed in what is really a 4th dimension, where quadrillions of data points are gathering about every person and everything and every flow and every item and object in the world. And that space is more representative of reality than you yourself are, because that space knows more about you than you know about yourself. And if this process of changing the dimensionality of your thinking is what brings about the scientific revolution, then a similar perspective change now is going to radically change how we think. And I think it will bring on something that's probably bigger than the scientific revolution. So I don't know if that elevator pitch, this is what my next book is about, makes sense, but it's about drones happen to show me we're in a dimensionality change moment in history, and they don't happen very often. And it's important for people to understand, what is it going to be like operating in this new 4th dimension?
That's so interesting to me, Pippa, because you're talking about physical dimensions, yet at the same time, I know you're a geopolitical consultant, so you're obviously aware of all these other things that are major changes going on in the world, where we see, for instance, a lot of younger people think capitalism is a problem, we should throw it out and use socialism instead. In the monetary world, we have this new trend around modern monetary theory, and that's not actually a new theory, but its popularity seems to be a very recent sensation. It seems like society in general is opening up to very large changes on a number of different fronts all at once. Are these things related?
Totally. And in fact, it's interesting you mentioned money, because that's one of the things that changes. And what I'm arguing is actually it's both, in the sense that it's a digital doppelganger of yourself or a thing, and a place where time takes on a different characteristic. So if we talk about what does that change, one of the things that changes is money, because you won't be printing money on printing presses anymore. In a digital world, you click a button and suddenly you can have any unlimited number of, quote, coins suddenly are real, because it's just digitized. It's electronic impulses. So in that world, what the heck does monetary policy mean? We're going to have to completely change how we think about, the quantity of money affecting its value. In a digital world, you can change the quantity of money in a blink of an eye. And does it really change the value? Well, not necessarily, because we don't have the physical constraints anymore. And that's one reason that I'm reading a lot of books right now. And I really strongly recommend to everybody who's interested in markets and trading, who usually doesn't have any time to read, or they only read things that are technically about business and the economy, which means they're just reading all the same stuff. They're stuck in the same paradigm, the same conversation. If you want to get your head out of that space and begin to understand very, very different ways of thinking, I have two books that I think are absolutely astonishing. One is called The Mushroom at the End of the World, on the possibility of life in capitalist ruins. And it won the Bateson Prize, which is the highest scientific prize for new literature, I think in 2016. And that whole book is about the capitalism that occurs at the fringes of society, at the fringes of capitalism. That even where capitalism doesn't seem to exist at all, there it is. And the whole book is about refugees from Japan during the aftermath of World War II, when they were all living in internment camps in the United States, the refugees from Vietnam and Cambodia and Laos. And all of them, it turns out, were very, very skilled at finding one particular type of mushroom called the matsusuke, which is incredibly valuable and very difficult to find and very difficult to ship, but achieves valuations that would make most investors' eyes water. And their expertise in going into the sort of unpoliced forests of the United States in places like Oregon and Western America above California, and then harvesting and creating an entire supply chain around one single commodity that's incredibly high value, and communities that form and capitalist structures that start to form at the edge of capitalism. So if you're in a moment where you're really thinking, gosh, does capitalism really continue to exist? Is it the right approach? Does socialism make more sense? You know, as we enter a digitized world, what is the right form of exchange between people? Then this book is a brilliant, mind-bending eye-opener to ways in which capitalism works, even where it's not supposed to. So that's one that won't be on anybody's reading list. It's so far off the beaten track. And this will be my last one. I won't bang on because I can be a real librarian. I mean, I got a zillion books that I think everybody should read. But this one is a truly, truly revolutionary book by a guy called Federico Campagna, who is probably in his mid-30s, incredibly young. And I would say he's one of the leading philosophers of our generation that nobody's ever heard of, but his thought process is so precise and elegant. And he wrote a book in 2013 called The Last Night, Anti-Work, Atheism, and Adventure. And what he writes about is, as we've entered a world where capitalism defines our lives to the point that we don't have any free time, we're all working so hard that work has become our new religion. You know, we complain that we may be earning money, but it's not enough, and we're not living as well as we wanted. And it kind of explains how capitalism, even though it delivers these amazing outcomes, right? More longevity of life, less people in poverty, you know, all these great outcomes, why people feel that they might be worse off. And it's an absolute anti-capitalism book. It is basically an anarchist writing it. But if you really want to ask the right questions about what is capitalism and what can it deliver, I think it makes sense to go read what does an anarchist have to say about it and really think about the questions that he poses about technological processes and is progress always progress for everybody? And if it isn't, how do we think about the ones for whom it isn't? So again, in this new digital world we're going to be in, I would argue we're not going to have capitalism, we're not going to have socialism, we're going to have something new, because the operating environment is going to require new governance structures. And you know, I wrote about that in my last book, because having this new digital space changes the balance of power between states and citizens, between companies and customers. I mean, we're seeing that with Facebook right now. So if you want to read about something completely opposite to what most people are studying, this would be the book for that.
Well, Pippa, we really look forward to getting you back on in a few weeks so that we can get the update on your own next book. Meanwhile, in the interest of time, we'll need to leave it there for this week. Art Berman is coming up next after this. Petroleum geologist Art Berman joins me next. Art prepared a fantastic slide deck for us, folks. You're going to have to go to the homepage at MacroVoices.com and look for a download link in the description of this All-Stars episode. We realized that our Research Roundup email, which is our usual mechanism for delivering you links to download content, doesn't go out till Thursday. So we'll work that out before the next All-Stars show and come up with a better process. But for now, you'll need to go to the homepage at MacroVoices.com to get Art's slide deck, which I highly recommend that you download. Art, let's go ahead and dive in. As I see slide 2 here after the title slide, you're starting right out on the first bullet saying a further price decline is probable. What's going on here?
Well, as you know, Eric, we had a week last week that should have sent prices to the moon between the U.S. not waiving any more sanctions on Iran and then 1 million and a half barrels of contaminated oil coming out of Russia going offline for a couple of weeks. And for sure, oil prices went up initially, but by the end of the week, the rally basically fizzled. So the question is why? And looking at the first graph on slide 2, I'm just showing oil price volatility for WTI. And generally, when volatility's high, look out, prices go low. And what we saw on Friday was that oil price volatility was the highest in 4 months. And the last time it was that high was right at the worst part of the price collapse last year. The slide on the right is fascinating because here I'm just showing every forward curve for Brent from the middle of 2018 to the present. And what it shows is that the red curve, which is last Friday's curve, although it's substantially lower than previous high oil prices in October and June of last year, the steepness of the backwardation is greater. So despite the fact that the oil price rally fizzled last week, or apparently fizzled, this is telling you that the market has a lot of concern about supply security, at least on the Brent side. That means we should expect to see more sentiment-driven price rises and price declines as things go forward.
Moving on to slide 3, how should we interpret this Iran situation? U.S. said, look, no more Iran sanctions. Then they kind of backpedaled a little bit and said, well, we're phasing them out, but we're not sure how long that's going to take. What should we expect here?
More of the same. I mean, this is, we've had 2 gigantic head fakes from the U.S. administration. Last summer, we were going to put the screws to Iran. Oil prices went super high in August, September, and October. And then Trump said, well, never mind. We're going to grant a bunch of waivers. And of course, prices collapsed, not just because of that. So this time around, he says, okay, we're not going to extend the waivers. Price went up $2 a barrel in general. And the question is, he says, well, Saudi Arabia and UAE can make up the difference. Can they? So slide 3 simply shows on the left, I think this is Bloomberg's estimate of how much could go offline because of no Iran exports. It's about 1.3 million barrels. Slide on the right shows my best guess as to UAE, Saudi Arabia spare capacity, because they're the only 2 that really have any spare capacity in my view. And it's roughly 900,000 barrels a day. So you look at it and say, holy cow. Yeah, I see why there's a concern. There's no way that these guys can make it up. Now, how do I come up with this spare capacity? Well, nobody knows. All I'm doing here is showing what the maximum output from UAE, Saudi, and Kuwait has ever been. And historically, the highest was last November at 17 million a day, November 16 before the OPEC Plus production cuts, it was about 17. So I'm saying it's somewhere in there. Nobody knows. So if you look at their current and subtract it from the max, you get 895,000 barrels a day. So you look at this and you say, okay, we're in trouble. And you add to that, Libya's got a civil war going on, Venezuela, et cetera, et cetera.
And on slide 4, you're saying that the expectations around production are probably exaggerated.
Yeah, that's what it looks like. So all I've done here is say, well, let's go back and look at what happened. What was Iran producing before the 2012 both UN and U.S. specific oil targeted sanctions? They were producing about 4.2 before those sanctions, an average of 3.4 between 2012 and 15 during those sanctions. And you go look then at what was the lowest they ever produced, and it was 3.14, 3.15 million a day. Well, so what are they producing today? Well, they're producing a little bit less than 3.3. So historically, this just says, gee, guys, seems unlikely that production from Iran or exports from Iran are likely to drop much lower than they are right now. How is that possible? Well, we can have that conversation, but Iran is very good at figuring out ways of, getting oil out through the black market, through unmarked tankers, et cetera, et cetera. It's not, that's not really the point. The point is that we got to have some context around this thing. So, let's be extreme and say, well, what if it goes down 500,000 barrels from the 3.3 average so far in 19? Well, we just got done saying that Saudi and UAE have got something like 900,000, so no problem. And I think this is what the market figured out in the course of the week, and that's why the price rally fizzled.
Slide 5, oil price collapse of 2014 and 2018. What are we looking at here?
Yeah, it's really important to understand that the oil price collapses of both 2014 and 18 were not just sort of corrections or whatever people like to call them. And okay, everybody agrees that 2014-15 was huge. The price of oil went from 110 to 50 or so Brent. People tend to look at what happened from October through the end of December last year, 2018, as, oh, well, it's over. Well, we thought the same in the spring of 2015. And I'm here to say, no, these are super significant events. These are structural changes in the way that oil is valued. So the narrative is, oh, well, OPEC did this. OPEC overproduced in both cases. Trump said he's going to cut the Iran exports. Saudi went berserk and flooded the market. Well, that's not what history says. What it says is that in both price collapses, the dominant reason was overproduction by the United States and Canada. And in fact, that all of OPEC plus, including Russia, put together, they increased production, but not anywhere near as close as much as U.S. and Canada. So non-OPEC increased production about 3 times more than OPEC plus in both cases. So the other thing the slide on the right shows what's going on now. And what's going on now is that we're back to the races, that after a January low, everybody who can of the major producers is producing their ass off again. So oversupply is a big concern that a lot of people seem to lose in the press narrative, the analyst narrative of outages.
Moving on to slide 6, I immediately recognize your infamous comparative inventory yield curve. Now, for any listeners who are not familiar with the comparative inventory model, you really want to learn about it because it really is the center of Art's work. We don't have time to describe it today. So, Art, let's assume everyone already understands comparative inventory. Listeners, if you don't, just type Art Berman's name into the search box at MacroVoices.com. Look up some of his past feature interviews where we've talked about comparative inventory in detail. Give us the update, Art. What are we looking at here in terms of comparative inventory developments?
Eric, what we're looking at on the left is WTI, on the right, OECD minus US, so basically Brent. And what both of them show is that the range of price excursions that we've seen over the last several months are extraordinary. They're at least equal to or greater than anything we've seen in the last 5 years. So message from that, expect more of the same. At the same time, what are the realistic expectations for, let's just say a WTI price of $75? Well, slim to none, basically, other than a brief sentiment excursion, because comparative inventory gives you that calibration, and it says, well, if you want to get to $75, this is sort of where you need to be in terms of drawing down inventories. And what I'm saying here, or what comparative inventory is telling us, is at the lowest inventory we've had in the last 5 years, which was in May of 2018, price only got to $71.25. So what would have to happen is we'd have to go way to the left of that. We'd have to draw inventories down far more significantly than we have ever since this whole mess began in 2014. Is it possible? Sure, it's possible. I'm not saying it's not possible. I'm just saying this is what needs to happen, basically, to get to a sustainable price of, say, $75 WTI. Brent says essentially the same thing. In fact, Brent, if you go into the details of the chart, which we're not going to do right now, despite the higher Brent price, the comparative inventory says, well, really and truly, though, the market values it about the same as WTI, which may be a surprise, and I'm not going to try and explain it, but that's what it is. And so as we try to understand Khalid Al-Fali's comments that he's skeptical about increasing production, I'm not saying he looks at my chart, certainly. I'm sure he doesn't, but he probably looks at something similar, and he looks at this and says, look, guys, I don't see a lot of potential here for price other than based on sentiment, going a whole lot lower or a whole lot higher. So tell me why I should do something on production increases or cuts.
And finally, Art, slide 7, forward curves.
Yeah, what these slides show, Eric, is simply that where WTI and Brent are right now is right about where they ought to be. And if people think that prices ought to go a lot higher, I'm not saying they can't, but we have to draw down inventory a whole heck of a lot farther than we have at any time over the last 5 years. That's, I think, why Saudi Arabia and its spokesman are sort of skeptical about either increasing or decreasing production beyond what they've agreed to.
Well, Art, that was a great update, and I'm sure our listeners really appreciate it. But ironically, as much as I feel like I should be thanking you and welcoming you to become one of our most frequent MacroVoices All-Stars, I'm afraid it's my duty to fire you instead. So, Art, it's my duty to inform you that your first MacroVoices All-Stars appearance will be your last MacroVoices All-Stars appearance. Flintstone, you're fired.
Oh, no, I didn't know this was going to be the Gong Show, Eric. That's terrible.
Well, Art, before we panic our listeners, let me explain. The reason that neither Art nor any of our other all-star energy experts will be featured on future MacroVoices All-Stars episode is simply that my original plan was to rotate the crude oil guys among the all-star experts so that each week's All-Stars episode would have one crude oil energy markets expert along with a bunch of other non-energy focused guests. But then a miracle happened, Art. I was blessed to have some of the most luminary names in the industry all sign up at the same time to participate. You were first, Art, then Anas Al-Haji, whose personal connections in the Middle East give him profound insights above and beyond what the talking heads on the cable channels have to say about energy markets, signed up next. Then we got Hedge Energy Markets chief Joe McMoneagle, who agreed to join the team. Then we got Pat Hemsworth, the commercial broker who moves big futures positions for commercial hedgers and actually gets involved in selling entire tanker ship cargoes of oil and finished products to physical market buyers all over the world. So needless to say, Pat's contacts and insights into the physical market give her a whole new perspective on what's driving the financial markets. Then we scored Tracy Schuchart, better known by her Twitter handle, Shy Girl. Tracy is probably the most popular and prolific personality among oil traders on Twitter, and she's been trading crude oil futures every single day for more than a decade. Then we got Chris Cook, the former market regulator who was once responsible for trying to control the enormous amounts of market manipulation that still occur today in energy markets. Chris, needless to say, has all kinds of insights that add to this picture. So when I realized that I had that kind of talent lined up, I thought it would just be criminal to rotate you guys through weekly positions on the All-Stars show. So we've done a last-minute replanning, and we're going to create a brand new podcast called MacroVoices Energy Week, which we're extremely excited about. So each weekly episode of MacroVoices Energy Week, I'll host it along with a panel of 3 industry veterans, and we'll be rotating all 6 of the experts, including yourself, Art, that I just mentioned a moment ago, so that over time you'll all have the opportunity to be on the show, but be on the show against each one of your other peers. So you all get a chance to bounce ideas off of one another, challenge each other's ideas, and so forth. For the inaugural show, which is going to air next week, the panelists will be yourself, Art Berman, Anas Alhaji, and Pat Hemsworth. Then the following week, we'll have Tracy Schuchart, Chris Cook, and Joe McMonigal as panelists. And then over time, we're going to mix it up so that you mix and match the guests and everybody gets a chance to appear opposite everybody else. The reason I'm so excited about this, Art, is it's going to give us the opportunity to set up a format where you and the other expert guests can challenge one another, not only in terms of presenting how you see the market, but asking probing questions of the other experts and so forth. So I'm really, really excited about it. I think it's going to be a landmark achievement in financial podcasting, quite frankly.
Eric, I couldn't agree more. These are people that I respect so much and interact with normally daily. I learn a lot from all these people, and so I'm excited about the opportunity to have that kind of real-time interchange, which Twitter's pretty good, but there's nothing like a live discussion. So I think this is going to be tremendous.
Well, folks, the first episode of MacroVoices Energy Week is tentatively planned to air next week on Wednesday, May 8th, 2019. Now, please bear with us if we have to slip that schedule. We've got a lot of irons and a lot of different fires at the moment, and it's going to take us a while to work out all the little wrinkles until we are eventually publishing each MacroVoices premium episode at a predictable time and day each week. Art, before I let you go, please tell our listeners what they can expect to find at artberman.com and about the services you offer to investors.
Yeah, Eric, thanks. I have a website, artberman.com. I'm a public speaker. I'm a petroleum geologist. I've got a perspective on oil markets. I do valuations for money managers and individuals. I understand oil markets and gas markets after 40 years, I better. So, come to my website, look at me on Twitter if you want to understand where I'm coming from on this stuff.
Fantastic, Art. We'll see you next week on the inaugural episode of MacroVoices Energy Week. Folks, stay tuned. Professor Steve is coming up next right after this. Economics professor at large, Steve Keen, joins me next. Steve, I'm really glad to have you on the program. I wanted to ask you in particular about Australian housing, since you used to live there and know that economy very well. After almost a decade of rising prices, looks like maybe finally the Australian housing market peaked in the middle of 2017. And from the last couple of figures, we're down about 5% or so. What's going on here?
It's something like that. It's Australia's had probably the world's longest running. Actually, it has definitely had the world's longest period without a recession. It's also had the world's longest period without a bursting house bubble, and the two are not accidents. The one is related to the other. So if you look at the level of Australian house prices and compare it to American back in 1980 and set them at the same level, fast forward to today, and American prices are about 1.6 times what they were in 1980, having reached 1.8 times before the house price crash that gave us the global financial crisis. Australian house prices are 3 times what they were back in 1980 in inflation-adjusted terms. And that has been all driven by an enormous amount of credit, which we all know how much American households borrowed during the subprime. It peaked, household debt in America peaked at just under 100% of GDP on BIS figures, Bank of International Settlements. Australia is sitting at 120% now, and it's finally headed south, headed down. And as the level of debt falls, the level of household credit falls, that's going to bring house prices with it, and I think take the Australian economy down as well.
Well, what are the actual consequences going to be for the Australian economy? Because, as you say, it's the longest recession period of any economy on the planet. Steve, I guess what comes to my mind is the higher they climb, the harder they fall. Is that going to be the operative theme here?
It's partly the operative theme. I think if you look at the what drives house prices, and this puts me completely outside mainstream economics. I find it hilarious that it does because I can actually derive this from simple supply and demand logic. But what I see as driving house prices is the change in the level of new mortgages. That's fundamentally what drives house prices up. And the logic behind it is if you look at what actually is the flow of demand for housing each year, it's the flow of new mortgages divided by what the price level is, which tells you sort of how many average houses you can buy. So you've got a relationship between the flow of new mortgages and the level of house prices. Do a bit of calculus here and you get a relationship between the change in new mortgages and the change in house prices. So to have sustained increasing house prices, you need sustained rising household credit, which are into accelerating level of household debt. And in Australia's case, they've managed to keep the pedal to the metal in that sense at the rate of 0.5% of GDP every year for the last 30 years. Now, that's what's boosted not just the house prices, but also the whole economy. America had a similar effect equaling before the global financial crisis. When the crisis hit, people started deleveraging rather than leveraging up. Your house levels that fell, and you went from about a plus 0.3 average pedal to the metal acceleration of household debt for about 20 years to -8. And I think Australia is on the verge of doing the same thing, but not from quite the same level of the rate of growth of credit. That's as Australia's debt levels have started to stabilise, the rate of change of debt slower than it was in America when the global financial crisis hit, but it'd still be falling from a much higher cliff.
Okay, so what is this going to mean for the Australian currency then?
Well, at the moment, Australia was thinking it was fighting inflation by putting up interest rates, but it held interest rates above American for quite some time. It never went down to zero. Now, American rates are heading up towards the 3% range. Australian rates are about 1.5%. They thought they'd be equalising to fight inflation. The last inflation figure came out 2 or 3 days ago. It was a big, fat zero, about 2% below what they're trying to achieve. When the house prices start to fall as well, the Reserve Bank will be forced, the Australian Reserve Bank, our equivalent of the Fed, will be forced to drop rates, probably towards zero, to try to stop the housing bubble causing the sort of crash that it caused in America. So I think we're going to see Australian rates going down to zero, the economy falling as well. And in that situation, I can't see the Australian currency doing anything other but falling.
Okay, and what does that mean for the Australian stock market?
Well, it's going to be complicated because, again, it comes down to what meddling is the economists in charge of government policy going to do. And knowing the Australian policymakers involved in setting monetary policy, I think the only group I could regard as dumber than the ones running the Federal Reserve are the ones running the Reserve Bank of Australia. So they ended up doing exactly the same thing that the Feds did when they got hit by the panic they weren't expecting in 2008. First of all, they pump money into the banks. Then when that doesn't work, they started pumping into the financial sector through QE. And exactly the same thing I think is going to happen in Australia. When that was done in America, the S&P bottomed at the hilarious number of 666, mark of the devil. It then rose to, we don't know the levels now, well, it was north of 2,000. All driven fundamentally, I would argue, by QE. So I think a similar thing will happen to Australia. The index will fall sharply because virtually half the index is the big four banks that are going to suffer very badly with the downturn. Then when the downturn gets to be severe, the Reserve Bank of Australia will dive in with QE, buy bonds off the private sector, drive down bond yields, give them money they can only invest in the stock market, and you'll see a turnaround. But I can see that probably take until about 2021 before it happens.
So when that occurs, it sounds like that's a 2009-sized buying opportunity in the Australian stock market. Is that right?
I would think so. I mean, again, I don't think it should happen. I think it's a bad policy that'll be causing it in the same way the Fed's QE, which I've called a pact with the devil. They can never stop doing it. It was a bad policy for the country, but an effective policy for the stock market.
Steve, I know you've taken a radical approach lately by basically ditching your university job and offering your services as an economics professor to the public at large, collecting donations effectively to support your work through the Patreon platform. Tell us a little bit about that and where our listeners can learn more about your work there.
Okay, well, firstly, the site I'm on is the usual Patreon website, www.patreon.com, and then /Prof Steve Keen. It's something which I started initially to raise funding for my software package, Minsky, which is designed to do nonlinear modeling of financial instability, which is why I picked the financial crisis back in 2008. And when I found that my university was being downsized, I thought, well, I'll change across to funding myself instead. The university's become so bureaucratically dominated, so badly funded, that it's really a waste of time trying to be an intellectual at one these days. So going out on Patreon, I'm now being supported to do my rabble-rousing against conventional economics and developing a viable alternative. With the Banking of the Public, I've got about 1,200 subscribers paying me about $10,000 a month, which is enough to give me a salary like equivalent to my academic salary. And what I'm hoping to do over time is expand out to the stage where I can further develop my software, Minsky, and start hiring research assistants as well. Because the thing the world most needs is sensible economics, and Lord knows we haven't got that coming out of the mainstream right now.
Well, I certainly encourage our listeners to check you out. Again, it's www.patreon.com/Prof Steve Keen. Steve, we're really excited to have you on MacroVoices All-Stars. We look forward to having you back in a few weeks for your next appearance. Meanwhile, folks, stand by because we've got Julian Brigden coming up next right after this. Up next is MI2 Partners founder Julian Brigden. Julian, help me understand. You have very wisely, I think, analyzed the business cycle, described late cycle dynamics, but it seems like the Fed's accommodative central bank policy is going to take the market higher regardless. Is there a point to even analyzing the business cycle, or is this all about the Fed?
Yeah, look, I think it's a valid, very valid question, Eric, but here's what I would say. The Fed doesn't manage or target the market per se. What they target is the business cycle, be that inflation or employment. Now, we have a somewhat distorted, or should we say a corrupted view of how this system works these days. We've talked about to our clients how the tail wags the dog. And what we mean by that is that it's the financial market that leads the real economy. So why have we got here? Well, I think essentially because CEOs aren't rewarded to make anything anymore. They are simply stewards of an equity price. And the minute their equity price starts flagging, their behavior changes and they look to move to save costs. And if you look at the earnings season that we've seen so far in the US, you can see that a lot of companies aren't beating on the top line, they're beating on the bottom line. So they're already beginning to look to save costs. And that's a result of the fall that we saw in equity prices in fourth quarter. And even allowing for the first quarter rebound, those equity prices are still flat. Well, that's not good enough for CEOs, right? That's just simply not good enough. It's no good for me to turn around to my board and say, well, the equity price was flat, or to my shareholders, the equity price was flat year over year. This is this ridiculous circularity that we've got ourselves caught up with. So already we're seeing some of the consequences of that. And so the end effect is that if the macro, it's not necessarily that the macro isn't important. It is singularly important to the Fed, but it does appear that it's the markets that tends to dictate that cycle. Because the Feds were raising rates all of last year, right? They've been raising rates for a while, but we only started to have problems as and when the equity market wobbled and the excesses that we believe have been created by, QE, optimal control, and all of these plethora of Federal Reserve policies that have been kicked in since the GFC. So that's what I would say. I say, look, it's not the macro doesn't matter. It does matter. The macro singularly does matter because that's ultimately what the Fed targets, but indirectly because the financial economy leads the real economy. That's really what you have to kind of keep an eye on, and you have to see how that affects the policymakers. Now, the question as the second part is sort of, have they done enough already? And the equity market definitively tells you yes. But, we just did an interview on Real Vision and we just asked that question, have they done enough to ensure the recovery? And from a macro perspective, I'm not sure. Not right here, right now. I mean, I think that the data, and I've been tweeting this as well, that the data actually in Q2 is going to be a lot worse than Q1. Our models had not shown a downturn in Q1, but they show a definitive downturn and a loss of momentum into Q2. We also are worried about the dollar. It's really not participating in the same way that we had in 2016. And I think these are valid questions that one needs to ask as to have they done enough. But maybe they have. I think we'll know relatively quickly. And, it's possible that between the Fed and, look, we've got more talk of infrastructure spending almost on a daily basis now coming from both the administration and the Democratic Party, at least the moderate Democrats, who I think are more concerned about the progressive Democrats than they are about Trump, of supporting some sort of infrastructure. So look, it's possible that policymakers have already done enough, and in which case the market could continue to melt up in the second half of the year. It's just, look, I'm watching some tactical signals before I personally get long.
Julian, you also recently posed the question, when will bond investors understand that when it comes to inflation, the Fed no longer has their back? And I assume you're referring to the FOMC being pressured by the White House to run it hot. Now we've got the academic community advocating prioritization of growth over inflation. So I guess the question, Julian, is does the Fed really still have control over inflation with their standard toolkit? Certainly BOJ and ECB have been at it for quite a bit longer and very aggressively with not a whole lot of success.
Eric, I think you make some astute observations, right? Certainly the ECB and the BOJ have had a tremendously difficult time in generating growth and inflation. And I think that the US has a few slight advantages. Firstly, it does appear the Fed has the advantage that they do deal with the reserve currency. And we've in the past talked on a number of occasions about how we view the dollar as, should we say, the heroine of global financial markets, because it literally is the reserve currency. And if you move its value, it literally, because it's a denominator of commodity and particularly oil prices and asset prices, it can be inflationary or deflationary. That's just not the case for the ECB and the BOJ. And we refer to what they can do in terms of QE as methadone. I mean, if the ECB were to blow out the balance sheet 100%, let's say, but in the interim the value of the euro fell 50%, then in dollar terms, you'd have no more liquidity to buy things. And so it's just not as powerful. So the Fed, if they can engineer dollar weakness, do have a significant advantage. The second thing that we have here in the US is we do seem to have a willingness amongst the fiscal authorities to spend money. Right, we saw with Donald Trump that willingness to spend money. We've talked to our clients about how, let's say, the Overton window, that sort of permissible range of discussion around the deficit, is shifting further and further into that spending camp. And I don't think there's any reticence at all to potentially spend money. And I think once you start to spend physical cash as opposed to quantitative easing money, we can see the impact, right? You drive unemployment lower, you push down wages. I think it's absolutely, to be honest, hogwash what you're getting from the Fed about the Phillips curve not working. If you go and look at tightness in the labor market and exactly at what levels wage inflation started to pick up this time, it picked up exactly at the same point you saw it pick up in the 90s and in the 80s. And it's just that the fact that we had super low employment and unemployment went incredibly high, that it's taken a long time to filter through in the system. But just because it's taken a long time to filter through in the system doesn't mean that it's no longer valid. So I think the Fed has some abilities to engender and create inflation, which are perhaps not present for others. And there is no question in my mind that, and we've posed this and we've talked about this, and this is what's in the Real Vision interview where I say, the choices are the devil or the deep blue sea, right? Inaction from the Fed, I think, given what I'm seeing in my underlying models, would almost inevitably lead to a recession. We're already starting to see tightening of credit. We're already starting to see unemployment lose downward momentum, and that is always a killer signal for a recession, almost always. And so I'm not really surprised to see the Fed move relatively objectively dovish. I think that they probably need to move quicker than they anticipate at this point to avert the risks of recession, but I think they've shown their hands, and they're very willing to go down that route. And if you remember what happened in 2016, this is exactly a repeat of what they did in 2016. We saw them pivot in January of 2016 after the emerging market crisis in 2015, where China devalued. We started to see that reflationary trade kick off. Now, there are some things that are missing, particularly the dollar, but I'm hoping that after a little bit of dollar strength that can change, but we'll see. And that's one of the reasons why I don't think they've done enough just yet. But remember, the bond market didn't respond to that reflation trade until the middle of the year. And by that point, it had actually rallied, pushing yields all the way down to 135 because the data was crap, right? Well, we have, I think, that potential well into Q2 because, as I said, I think the data is going to be poor. But ultimately, they were successful. And the bond market paid one hell of a price for that starting in the middle of 2016, right? I think that's exactly what they intend to do again. What they intend to do again is they intend to run this economy hot. We're screwed if they don't run this economy hot, right? We are an aging, indebted society which needs rapid nominal GDP growth. And I think by hook and by crook, they're intending to try and get it. And they've teed the market up for this, right? What more is it just than spin to try and hold the market in there with this latest line? Look, should have symmetrical inflation targeting. Right? We've run short, way short of our targets for years, guys. Trust us, we're the Fed. We've got your back. If we overshoot to 3%, you shouldn't worry. We know that long term it's going to come back down. Well, it doesn't always. It has, certainly in the last 30 years, but I believe we're coming to the end of that cycle. Okay? And to me, you'd be foolish as a bond investor to believe the Fed's got their back. They need to kill you. Right? They need to financially repress the value of debt. And the way you do it is not by pushing rates negative 25 basis points that they have, done in Europe. It's by running nominal GDP and inflation a lot higher than bond yields can go, because they can't go much higher and become real yields because there's too much debt out there. That's the lesson of the late 60s, right? And all this talk of punting the cycle. This is a repeat. Bloomberg's running stories. This is a repeat of 1995 or 1996. Okay, they punted the cycle, but it isn't necessarily like 1995 and 1996. It's arguably the economy is much tighter than it was back then. So I'm pretty convinced. I don't think they've done necessarily enough right here and now to ensure this, but the intention is to screw bond investors. It has to be to screw bond investors, just as it has to be to screw retirees in terms of their entitlements, right? I can give you a check for $1,000 for your retirement in 5 years' time. It just can't be worth $1,000 in real terms. It has to be worth 500, right? And the same is going to happen to bond investors, I'm pretty convinced. And they can do it because they can ultimately, I believe, try and throw the dollar under a bus. And it's essential. We're not there yet. In fact, I think the risks are we're going to push the dollar a little bit higher first. But those are, to me, are just opportunities, that you'll get then to sell treasuries. Ultimately, I think the trend is clear.
Julian, before we let you go, give us a quick rundown of what you do at MI2 Partners.
So we have our institutional product, which is the MI2 Research. We're in collaboration with Raoul Powell for Macro Insiders, which we do through Real Vision. And you can follow our free information on Thoughts on the Road, which you can find us either on our website, which is mi2partners.com, or follow us on Twitter, which is @Julian@MI2.
Fantastic. We look forward to having you back in a couple of weeks for another update. Folks, stay tuned. We've got Luke Gromen coming up next, right after this. Up next is Forest for the Trees founder Luke Gromen. Luke, you are probably most widely known for your long-term bearish views on the U.S. dollar, although you've expressed a tactical bullish view, at least temporarily. Of course, we saw a breakout above 98 this week, so very curious to get your thoughts. How long do you think this stronger dollar can run from here?
Yeah, hi, Eric. Yes, it did. We saw that pretty notable breakout last week above 98. And we'd been watching the dollar with great interest because it had been trading in a pretty tight range for the past 5 to 6 months. And it really had not even risen much during the risk off during fourth quarter 2018. And we had been thinking that it was trading like that. Perhaps it was being kept in a range during U.S.-China trade discussions. But obviously, that line of thinking appears to have been wrong. Now, ultimately, we would go back to what we've highlighted in our research and discuss with you on MacroVoices at the end of February, which is that as long as global central banks are de-dollarizing their FX reserves, they're buying gold while not increasing holdings of treasuries, and thereby effectively funding U.S. deficits, then growing U.S. deficits will have to be financed entirely by the private sector, both foreign and domestic. Now, as that happens, this will increasingly crowd out the global private sector, driving the dollar higher. Now, as we highlighted on your show in late February, foreign central banks de-dollarizing, not buying treasuries, driving the dollar higher is a very counterintuitive dynamic. And the reason this happens is twofold. First, the global private sector has a finite balance sheet and marks their holdings of treasuries to market, unlike central banks. And second, because of the large installed base of dollar-denominated debt outstanding, which is just the result of the dollar-centric system that has existed over the past 50 years. And so what happens is that as foreign central banks stop buying treasuries, then those treasuries have to get bought by the private sector. However, the private sector's balance sheet limitations forces a choice, really. And the private sector can buy treasuries or it can buy other things. And so essentially, if the private sector buys treasuries, it begins crowding out consumption in the U.S., which in turn begins to hurt global and U.S. economic growth, starting with the outsides of the system, emerging markets, et cetera. But all of this reduces the supply of the U.S.'s dollar exports to the world. And so if U.S. government deficits rise, increasing the supply of treasuries, which further reduces the exports of dollars to the world, further slows global growth, wash, rinse, repeat. So we get this squeeze. Now, as others and we ourselves have noted, this reduction in global growth and the supply of dollar exports occurs in a system that I always call it X trillion dollars in debt globally, and which therefore needs dollars to pay the interest on the debt. And so as the dynamic we described earlier cuts into global dollar supplies, in this context of a persistent dollar bid from global dollar debt outstanding, it drives a short squeeze higher in the dollar. And so it sets up this curious counterintuitive dynamic. The de-dollarization of both central bank FX reserves and of global commodity markets initially drives the dollar markedly higher. We saw the first leg of this in the third quarter of 14 through the fourth quarter of 16, and now it appears we may be seeing the next leg higher. At least, that's what many people think.
Okay, if they think that, are they right? Are we setting up for the next extended leg much higher in the U.S. dollar?
I think it's possible, but I don't think extended is likely.
Luke, why do you think in that case that the dollar is unlikely to rally as long or as far as a lot of people think? Needless to say, it's a very popular view suddenly.
Yeah, the reason I think that, Eric, is because the dollar became structurally too strong back in the third quarter of 2016. That was when U.S. deficits began crowding out the U.S. economy again, driving U.S. deficits as a percent of GDP higher for the first time since 2009. And that had historically signaled recession or coming weakness in the dollar. And the 12% decline in the dollar that we saw in 2017 that surprised most traders bought some time for those deficits. But once the dollar began rising again in 2Q18, it was less than one quarter until foreign risk assets came under pressure and less than 2 quarters until U.S. risk assets suffered a sharp sell-off in 4Q18. And so these same dynamics remain at play now. Risk assets have bounced, aided by the Fed backing off further rate hikes and promising QT would end later this year. But now this move in the dollar has changed things. And as we've been writing about in our research and noted on your show in late February, as long as global central banks are not buying treasuries, the U.S. is subject to its own version of a trilemma. The U.S. can only have 2 of 3 of higher Fed funds, higher dollar, higher equities. And while the Fed has stopped raising rates, as the dollar moves higher as it has, then there's only 2 release valves to the system, either lower equities or lower Fed funds rates. And the Fed might endure lower risk assets for a brief time, but our view is that fourth quarter 18 showed they just cannot tolerate risk assets declining for very long. And we think that's because IRS data shows that estimated net capital gains plus taxable IRA distributions are around 200% of U.S. personal consumption expenditure growth, or PCE growth. And PCE is about 2/3 of U.S. GDP. And critically, This does not include stock options or restricted stock because these are taxed as ordinary income. So the stock market could easily be responsible for 250% or 275% even of annual growth in U.S. PCE. And in other words, if stocks don't rise, U.S. consumption cannot rise, and therefore U.S. GDP likely cannot rise. And once we understand this context, we understand why the Fed always folds so quickly when we have a risk off. We saw this in the data in 4Q18 and 1Q19. December was the worst December sell-off in 87 years. And what we get in January and February? Surprisingly bad consumer spending data. And so once we understand this full context, then it becomes clear the dollar rally, in our view, cannot be allowed to run for very long because it will quickly send the U.S. and global economy into a recession pretty quickly.
Now, the dollar bulls, just to play devil's advocate, would say, wait a minute, Luke, the U.S. is heading into a recession. So many expert economists agree that by the end of 2019, we got to hit some kind of recession. That's typically dollar positive, at least initially. What would you say to that argument?
I would say they're correct, with an important caveat, though. These are not typical times. And by that, I mean, the last time the world economy went into a recession and a global sovereign debt bubble was almost 100 years ago. And most investors are using the playbooks of the last 30 years, but we can throw the playbooks of the last 30 years away because no one alive has ever seen anything like this in person. Nobody alive was trading the last time a recession was a threat to global sovereign debt solvency, but this is the case now. And so it follows that global central banks will likely act early and aggressively.
Early and aggressively, by that, do you mean you think the Fed is going to act more aggressively than the consensus believes, or just in line with consensus?
I think they will end up acting more aggressively than most investors think. And importantly, it's not just the Fed that can act. We now know that the U.S. government is negotiating a trade deal with China that has an FX component to it. We had been hypothesizing that was the case because there were photos of Treasury Secretary Mnuchin and PBOC Governor Yi discussing cybersecurity. And the question we had asked our clients at the time was, with all due respect, what do either Mnuchin or Yi know about cybersecurity? We said they have to be working on an FX deal. And a few weeks later, it came out that, yes, in fact, they were working on such a deal. Now, if the goal is more balanced trade between the U.S. and China, it would stand to reason a stronger dollar would work against that goal. So for us, if they're working on an FX deal, if the deal gets done, it's a deal that will likely weaken the dollar. So between the U.S. trilemma enforced by global central bank de-dollarization, likely putting pressure on U.S. asset prices if the dollar doesn't fall soon, and the U.S. economies and therefore the Fed's sensitivity to declining asset prices, and U.S. government negotiating an FX deal that will likely weaken the dollar and create enforcement mechanisms, it just seems like there are a lot of ways to get the dollar down in a sort of binary fashion that not a lot of people seem to believe right now. So for me, the net of it is that authorities understand all of this, and as such, I don't think they'll allow the dollar to rise to destructive levels for an extended period of time.
Okay, but what if the U.S.-China trade deal breaks down? Do you think that would cause the U.S. dollar to rise?
I do, yes, likely sharply, but would then tie into my point about the dollar rising to destructive levels. If you get a U.S.-China trade deal breaking down chaotically, our research shows that just a return to the long-term average pre-China in the WTO, U.S. corporate profits as a percent of GDP would have to fall by 30 to 60%. And with U.S. corporate debt at all-time highs, the quality of that debt at or near all-time lows, a drop in corporate profits of far less than 30% would likely be enough to create severe distress in the corporate bond market and corporate equity markets globally. And you remember what we said before, without asset price inflation, the U.S. and global economy cannot grow, they'll shrink. And so the question is to what degree do central bankers understand this? And we keep going back to a BIS white paper from November of 2016 that said there may be no winners from a stronger dollar. Our view is they understand this. They've understood it for years, which brings us to our conclusion of the dollar breakout. This is likely, if it just stays here, let alone rallies further, it will likely accelerate events meaningfully, both on the trade front and on the Fed front. And so we came into the year with a report asking, when will the Fed begin growing their balance sheet again? We said on January 9th that the answer was much sooner than expected, likely by no later than early 2020. And that remains our answer, if not sooner. And I think the recent break of Fed funds above interest on excess reserves, a very big clue that, our view from earlier this year remains a correct one. It suggests that there's starting to be some acute levels of crowding out of U.S., on the U.S. side of things by U.S. government deficits. So it's really hard to overstate the importance of that as, for timing perspective on the dollar, on emerging markets, risk assets, et cetera.
Well, Luke, I really appreciate a fantastic report from you. We've got you scheduled already 2 weeks out for another update. Before I let you go, though, give us a quick rundown of what you do at Forest for the Trees.
Sure. We aggregate a large amount of data from publicly available sources in a unique manner, and we're just looking for economic bottlenecks because it's been our experience on nearly 25 years on Wall Street that excess returns accrue to those economic bottlenecks. So we're just scanning a lot of data and trying to help our customers make money.
Okay, we'll talk to you in a couple weeks. Folks, stand by. We've got Danielle DiMartino Booth coming up right after this. And our final all-star for this week's episode will be Danielle DiMartino Booth, of course, very well known as a former Fed insider, worked at the Dallas Fed, and wrote the extremely popular best-selling book, Fed Up. Danielle, we're at new all-time highs on the stock market, despite the fact there have been a lot of serious concerns about the economy, recession signals, and so forth. Feels to me like Fed policy got us here, but you're clearly the expert. Why are we where we are with markets, and what is the Fed's involvement?
Well, it took more than the Fed freaking out to get us to all-time highs. You actually also had to engage the People's Bank of China. In the background, as our markets were sliding into their Christmas Eve bloodbath, at the same time, the Chinese economy was slowing to a 30-year slowdown. So it's a big number, 30 years. They've literally doubled the number of registered drivers over the past 7 years. They've urbanized areas of their country that would bury the entire United States of America. But the slowdown, the societal implications put the People's Bank of China into high gear. And in addition to the Powell pivot, which we'll get to in a second, the People's Bank of China effectively put out somewhere between $900 billion, $1 trillion worth of stimulus in 3 months. Let's put that in perspective. When it was QE infinity going at full blow, it was $85 billion a month. So this is something that they did in a 3-month period of time, which is why the Chinese stock market led the rally in risky assets, that big recovery. And then you had on top of that, the Powell pivot. And I think that's probably the least understood aspect of the current rally in terms of its origin.
Well, let's not go any further then. Powell pivot. A lot of people think that he's trying to save the stock market. Is that the motive, or is it something else?
Well, the stock market it's just a beneficiary. On Halloween, the bonds of General Electric were downgraded by Moody's. The market was already nervous going into the month of October, as you well know. And that second downgrade by Moody's that followed the one by S&P was enough to really set the bonds of GE, which were investment grade, into junk territory. So within 2 weeks, on November the 14th, 2018, the primary issuance market in the junk bond market shut down, went into a deep freeze. 41 days later, we hadn't seen a single new bond issued. And at that point, the Bank of International Settlement, the World Bank, the World Trade Organization, all manner of international organization, they had taken notice of the fact that we would have a much bigger issue on our hands if the credit markets went into a deep freeze versus the stock market. So again, it was the fact that spreads gapped out at a historic rate. It was the fact that outflows from junk and investment grade bond funds were historic. Leveraged loans completely froze up. It was the freeze in the credit markets that caused Powell to blink and change his tune, do the about face. The reason we see it and feel it as we do in the stock market has to do with the fact that if CFOs are forced to tend to their balance sheets, i.e. tend to bond market investors because the GE moment forced that, the one thing they cannot do, the one thing their hands are tied against doing is share buybacks. No share buybacks, no stock market. So as soon as the Powell pivot unfroze the issuance market in the U.S. bond market, all of a sudden, CFOs were free to go about having fun and being wild again. And lo and behold, in addition to record Chinese Q1 stimulus, we have seen record U.S. Q1 share buybacks. You put the two together, we better be at all-time highs.
Okay, so your take is that Powell did not step in to bail out the stock market. He stepped in to bail out credit markets, but clearly the action was stepping in to bail out the market, despite having said kind of the opposite in his inauguration. So what is next in terms of Fed policy? What should we expect? And how does Rich Clarida fit into the story?
Well, I want for people to pay attention to Rich Clarida. I've coined a whole new hashtag insurance rate cut. Doesn't take much to pull it up on Twitter. And if you want to think of this one individual from PIMCO who's also a PhD in economics, so he speaks both languages. He's got feet in both camps, so he can hang on every side of the FOMC. Think of him as being Mario Draghi and Janet Yellen fused into one human being as being world's most dovish individual. He is going to look out for the credit markets at all costs. He is the one who suggested an insurance rate cut, kind of like what we had in 1994, to go back to his most recent public appearance. So you're talking about all-time highs, a U.S. economy that is still technically expanding, and somebody stepping in and saying, just in case something happens in the future, as soon as we finish quantitative tightening, which, by the way, is on schedule to be tapered in May and end in September, once we get there, then I think maybe we should take out an insurance rate hike just to be sure that Fed policy doesn't push the U.S. economy into recession. Kiss XXOO, love Rich.
Danielle, what else has your eye this week in terms of Fed policy?
Well, I think it's interesting. The thing that people ask me the most is how much time did the Fed buy? How much time did the People's Bank of China buy? And my stock answer is, look, we have automobiles at the highest level since June of 2017, when the automobile industry was about to go into recession, right? Automobiles and housing, they lead the U.S. economy. And we've seen weakness in existing home sales. And if there's one, make that two numbers to remember these. The Powell pivot created a 99 basis point backtrack in the 30-year conventional mortgage rate from a high of 5.05% last year to 4.06% at the late March lows. Once we got to that 4.06%, refinancing activity year over year was up 58%. I mean, whoa, nosebleed. 10 basis points and 3 weeks later. That's it. 10 basis points and 3 weeks later, mortgage rates are up, again, by 0.1 of 1 percentage point, and you've put the brakes on refinancing activity. Now it's up only 13% year over year. It was down week over week last week, and you've seen purchase activity come to a screeching halt. If there's one message to be conveyed by the two most leading sectors of the U.S. economy, housing and automobiles, it is that they are skidding to a stop despite everything that the Federal Reserve has done. In a bigger picture, looking globally, if you look at Germany, if you look at South Korea, if you look at Japan, i.e. the world's three largest car producers, everything that's been done in Beijing has been insufficient to pull these big manufacturing hubs out of their malaise. So again, it comes down to a matter of what is going to be next. Jay Powell knows exactly how much wiggle room he has, 10 basis points. The People's Bank of China knows that they're going to have to up the ante. They're going to have to increase the amount of stimulus if they're going to pull not just the Chinese economy, but their trading partners, their biggest trading partners, out of recession. And I think that it's the law of diminishing returns that investors have to pay the closest attention to. In our most recent Daily Feather, we wrote about the fact that managers now see the U.S. labor market at its weakest point since 2009. This is in stark contrast to the lowest income earners who still think everything is fine, which they should, because they don't know that things are bad until they get fired. But the managers and the owners, they see things as getting worse. The Duke CFO survey conveyed a similar message. Last autumn, they thought that we were going into recession in 2019. Fast forward to the latest survey, they think we're going into recession in 2020. All we've done is buy time, but on a fundamental level, we've not seen improvement in the economic backdrop, nor will we until and if Jay Powell and his central banking peers around the world can pull out that much more stimulus 10 years into a recovery.
Danielle, before I let you go, I want to just ask you to fill our listeners in. You've got a new project, Quill Intelligence. You just mentioned the Daily Feather. Tell us a little bit about what you're doing there and what you're up to now that your book has become such a fabulous success.
Well, what I wanted to do with finding Quill Intelligence was introduce a daily product for retail and institutional investors, because why bother with sleep? Who needs it? In addition to the weekly newsletter that I've been producing since June of 2015, when I followed Richard Fisher out of the Federal Reserve. So go to QuillIntelligence.com, check it out. We're the Wayne Gretzky's of macroeconomic research. We don't care where the economy's been. We don't seasonally adjust our thinking. We just care where it's headed.
Danielle, we really appreciate it, and we look forward to having you back on in a couple of weeks. Listeners, I hope you've enjoyed the inaugural episode of MacroVoices All-Stars as much as I've enjoyed making it. Okay, a few of our All-Stars went a little bit beyond the 10-minute time budget that we gave them, but I didn't mind, and I doubt that you did either. It's a real privilege for me to have the opportunity to interview people of this caliber in rapid succession like this. But as the announcer says in every regular episode, MacroVoices is a listener-driven program. So now I need to call on you for your feedback. I am personally committed to making MacroVoices Premium the absolute gold standard in financial journalism, specifically targeting sophisticated investors. That means delivering exactly what you, the listener, wants to hear most. Personally, I like to think that we're off to a fantastic start with this inaugural episode of MacroVoices All-Stars, and we've also got the first episode of MacroVoices Energy Week coming next week. But frankly, my opinion isn't important. Yours is. So please, let us know what you liked most and where you see opportunity for us to make MacroVoices Premium even better. Can you think of a way to improve on the format of today's show? If so, I want to hear about it. Please understand, though, that there's just one of me and more than 40,000 of you regular MacroVoices listeners, so I can't possibly reply to every email. I do personally read every single message sent to info@macrovoices.com, but I'm forced to adopt a policy of not responding to most of them. Twitter is usually the best place to make suggestions because then your ideas are visible to other listeners and they can comment and build on your suggestions. So if you're on Twitter, please favor tweets to @MacroVoices and @Eric S. Townsend as the best ways to express your suggestions for how we can improve MacroVoices Premium. My goal is to make MacroVoices All-Stars a weekly podcast, but please bear with us through a few growing pains. I just shanghaied half of the cast and set up a new podcast for them, so we're going to have to figure out how to fill in the schedule. Eventually, though, I expect that we will have MacroVoices All-Stars and MacroVoices Energy Week both running every single week. Just bear with us until we can get that set up. I can't emphasize my final point strongly enough. It was hard to persuade such busy people to agree to regular interviews every couple of weeks in many cases. And frankly, some of the All-Star guests we invited to participate in the All-Stars format are still on the fence, not sure whether or not the benefit justifies the amount of time it's going to consume. Folks, I cannot say this strongly enough. It is you, not I, who have the power to decide the outcome. If every single one of you listening to the sound of my voice right now were to get on Twitter and tweet a few words of appreciation and respect and praise to every single one of our all-star guests in today's show, they would be deluged with positive feedback. Their decision to participate in MacroVoices All-Stars would be validated, and perhaps most importantly, the remaining prospective all-star candidates would realize this opportunity is worth their time, and before you know it, we'll be expanding to 2 All-Stars episodes a week. But if you decide instead to sit back and leave it to other listeners to express their gratitude on Twitter and through other means, well, then the project's going to flop. So, folks, you have the power to determine the outcome. I don't. Your feedback matters, and it matters a lot. So please find a way to let our All-Stars know how much you enjoyed hearing their views in today's podcast. And be sure to tune in to the Postgame segment in this week's regularly scheduled Thursday night MacroVoices podcast, when I'll be making a few more announcements about what's planned for MacroVoices Premium beyond the new MacroVoices All-Stars and MacroVoices Energy Week formats that we're launching this week and next. For MacroVoices Premium, I'm Eric Townsend.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Forthcoming Capital Management, LLC. For more information, visit MacroVoices.com.